This is my roughly £890,000 portfolio. And it probably looks very different to what most people are doing right now, because right now I'm more focused on protecting capital than chasing returns. When you look at the data, markets today are expensive by almost every historical measure. Valuations are near the top of their ranges, and investors are taking on more risk than they probably realise. So instead of leaning into that and fearing I'm going to miss out, I'm positioning more defensively. And in this video, I'm going to walk through why I'm doing that before I show you how my portfolio is positioned. Let me show you what I mean. When you look at US equities today, by almost every major valuation measure, they're near the top of their historical ranges. The CAPE ratio has been cheaper about 99% of the time, price to sales, again around 99%, and even forward price to earnings ratio, which tends to look a little bit more reasonable with earnings upgrades, is still in the top 15% of history. So however you look at it, you're starting from a pretty expensive place. Now it's worth saying not every market looks like this. There are areas globally that are more reasonably valued. But the US is such a dominant part of global markets and investor behaviour that when valuations are stretched here, it tends to influence everything else. And it's not just equities. Junk bond spreads are tight, which usually means investors are being slightly complacent. None of this tells you when markets will fall. They could keep going higher from here. But what it does suggest is that the odds are not especially favourable. So for me, this isn't about trying to call the market. It's about recognising that starting valuations matter. And when you're starting from a point like this, the range of outcomes becomes much wider, especially on the downside. So the question is, what do you actually do when markets look like this? For me, it's not about predicting what happens next. Markets could go a lot higher. It's about being prepared. And that leads me to position much more defensively than I normally would. So let me show you my portfolio. The largest part of my portfolio is in cash and short duration assets, about 39%, which is roughly 351,000. Now on the surface, that might look quite conservative, but for me, this is really about optionality. It gives me stability if markets fall, but more importantly, it gives me the flexibility to deploy capital if better opportunities come along. And in a falling market, cash is often the only thing that's actually going up, which puts you in a very strong position. The other thing that's changed more recently is that cash is now actually earning a reasonable return, which hasn't been the case for a long time. So this part of the portfolio is really about capital preservation and being ready to act. The next allocation is inflation-linked bonds at around 32%, which is roughly 285,000. This is really about protecting against one of the key risks I see, which is inflation staying higher than expected. These are mostly short duration, so they don't have a lot of interest rate sensitivity, but they do give you that inflation protection. So in a scenario where inflation remains elevated or even surprises to the upside, this part of the portfolio should hold up relatively well in real terms. And compared to holding pure cash, you've at least got some protection if inflation erodes purchasing power. So this allocation is really about protecting real returns, not trying to generate high ones. Then we have around 24% in what I would call defensive or absolute return strategies. This is really a mix of different approaches, things like macro hedge funds, long-short equity funds, and wealth preservation funds. The aim here is to have part of the portfolio that doesn't rely on markets going up, and is at least trying to generate returns across different market environments. Now, they are not perfect and they won't always deliver, but they do behave differently to traditional equities. So this part of the portfolio is really about diversification and reducing the reliance on markets moving higher. And finally, I have a smaller allocation to gold at around 5%. This is really there as a hedge against more extreme scenarios, things like financial stress, currency debasement, and a loss of confidence in the system. It's not something I expect to perform all the time, but in certain environments, it can be very effective. Historically, it's tended to do well when real returns are under pressure or when confidence in financial assets weaken. So this is how I think about the portfolio as a whole, not in terms of predicting one outcome, but in terms of how it behaves across different environments. On one axis, you've got inflation rising or falling, and on another, you've got growth, whether the economy is strengthening or weakening. So starting here, rising inflation and weaker growth, this is a particularly difficult environment for traditional portfolios. And this is where assets like inflation-linked bonds and gold can start to perform better because they're designed to protect real purchasing power. If we move across to rising inflation with stronger growth, inflation-linked bonds can still hold up reasonably well here, and some of the more flexible strategies can adapt. So again, you've got parts of the portfolio that should be relatively resilient. Then if growth weakens and inflation falls, this is where cash and short duration assets really come into their own. They provide stability and, importantly, give you the flexibility to deploy when opportunities appear. And then finally, in a more typical environment, falling inflation with strong economic growth, this is where traditional risk assets tend to do very well. And in this scenario, I'd expect this portfolio to underperform because I'm not fully positioned for that outcome. I'm more focused on protecting capital in less favourable environments. So that's a trade-off that I'm making. So let me walk you through my top 5 holdings. The largest position is CSH2, which is the Amundi Smart Overnight Return ETF at around 26% of the portfolio, roughly £230,000. This sits at the core of my cash and short duration allocation. It tracks SONIA, which is the UK overnight interest rate, so effectively earning something close to the base rate on a daily basis. Right now, that's around 3.75%, which is a meaningful return for something with very, very low risk. It's a synthetic ETF using a swap to deliver that return, which allows it to track the overnight rate very closely while remaining highly liquid. So in practice, it behaves a lot like cash, but with a better yield and full flexibility. And that's really the core of the optionality in the portfolio. The next position is short duration US inflation-linked bonds at around 15%, around 134,000. This gives exposure to US TIPS with maturities between 0 and 5 years, so duration is relatively low, around 2.4 years. The key driver here is real yields and inflation expectations. So you're protected if inflation comes in above what's currently priced into the market. At the moment, short-dated TIPS are yielding roughly 1.5% to maybe even 2% above US inflation, which is CPI. So you're being paid a positive real return while still having that inflation protection. This ETF is also hedged back into sterling, so you're not taking on dollar currency risk as part of the position. And because the duration is short, you're also limiting the downside from rising real yields, which has been a major risk for longer duration linkers. So this is really a more stable way of accessing inflation protection while still earning a positive real return. Then I have BH Macro at around 13%. This gives access to the Brevin Howard Master Fund, which is a large global macro hedge fund trading things like interest rates, currencies, and volatility. The key point is that it doesn't rely on markets going up. Returns are driven by large moves and trends in macro variables. So in periods of uncertainty or market stress, particularly when equity markets are under pressure, it has often performed well. In many ways, it benefits from volatility rather than being hurt by it. And because it behaves very differently to traditional assets, it plays an important role in diversifying the portfolio. Then there's the PIMCO Global Low Duration Real Return Fund at around 10%. This sits alongside my TIPS allocation, but it's actively managed rather than passive. It primarily invests in short duration global inflation-linked bonds, but with the flexibility to adjust positioning across different markets, real yields, and inflation expectations. So rather than just tracking inflation, it's trying to add value through active decisions, whether that's positioning around break-even inflation or relative value between regions. Duration is still relatively low at around 3 to 4 years, so you're not taking on large interest rate risk. So this complements the more passive tips exposure by adding a layer of flexibility and active return potential. And then I have a short-dated UK gilt maturing at the beginning of 2027 at around 7% of the portfolio. I bought this at a gross redemption yield of around 4.4% when it had a duration of 11 months, so actually quite recently. And compared to cash, it allows me to lock in a slightly higher return over a defined period without taking on much additional risk. I funded this by reducing my cash position and selling some of CSH2. So it's effectively moving from a floating rate to a fixed return. And because it's short dated, the sensitivity to interest rate changes is very low. I still think of this as part of my cash allocation because it can be sold if opportunities arise and the price shouldn't move very much. So those are my top 5 positions, and they make up around 72% of the portfolio, with the rest spread across smaller positions. So just briefly on performance. Year to date, the portfolio is up around 7%. That does include a gain from a position I exited earlier in the year as a discount narrowed. Global equities using something like VWRP are up around 5%, which to me is very surprising considering the year we've had. But I'm not comparing this portfolio to equity markets. My aim is to deliver returns of around RPI plus 3% over time. So the goal is to steadily grow purchasing power rather than trying to beat equities in any given year. And inflation using RPI is up around 0.7% this year. And given the current positioning, I'd expect this portfolio to behave differently to equities, particularly in stronger markets, but hopefully hold up better in more difficult environments. So that's the portfolio as it stands today. I'll be sharing updates as things change, both what's working and what isn't. If that kind of long-term real money investing is interesting to you, feel free to follow along. And thanks for watching.